Hi everyone, and welcome to our webinar with our superannuation provider, First State Super. They've got a webinar that's on managing your money and debt. We've got Felicia here presenting, so I'm going to hand over to Felicia now, and I hope you enjoy. Thank you.
Great. Hi, and welcome to the Silver Chain Group. My name is Felicia LaFrance. I'm an education manager with First State Super, and with me today helping out with some questions and answers is Scott Watson, and he is an education manager down in Canberra. So thank you so much for having us in your proverbial workplaces, so to speak.
So at the moment, that's all we've got as a fine.
Sorry?
Sorry, I'll mute people.
Sorry, what was that?
It was, I think she forgot to mute.
Oh, okay.
I'll mute them as they come through.
Oh, okay. Okay. So today's managing your money and debt. We will have a chance to do some questions afterwards, but if you have anything along the way, please feel free to use the chat function, and Scott will endeavor to answer those questions. So let's begin. Before we get started, we want to acknowledge the traditional owners of the land on which we are meeting. We pay our respect to their elders past, present, and emerging, and any elders from other communities who may be here today. Welcome. Before we start, just to let you know that all of the information that we're giving you today is factual, but it is general in nature. So it's not meant to be personal advice or to replace personal advice. We do have people that you can speak with if you do need something more personal. We will be providing you with a link that will allow you to comprehend so that Scott, since they're not financial planners, so I can't tell you what you should do, only what you could do. And with anything, obviously reading all of the relevant information related to that before making any financial decisions is always the best. We would encourage you to go to our website at firststatesuper.com.au, check out our product, as well as our treasure trove of facts and information before making any.
Hey, Alicia, sorry to interrupt. It might be worth just dropping off the video part. It might be worth just dropping the video part because I think there's some connection issues, that's all.
Yeah, you're coming up very scratchy.
What was that?
It might be worth just dropping off the video component and just keeping it to audio just as there's some connection issues, I think. Thanks, Felicia.
Sure. Sure, no worries. Can you hear me all right?
Yeah, that's much better.
Perfect.
Okay, perfect. All right. Okay, so this is what we're going to cover. We're going to give you a bit of a fund update. We're going to talk about managing money and debt. We're going to talk about how you can get engaged with your super and how you can boost your super, and of course, how we can help. But on July 1st, Vic Super and First State Super merged into one fund, which means that has now made us the second largest superannuation fund in Australia. It means we're managing about $125 billion in combined assets and have a little over 1.1 million members and clients. So we're not getting big for big's sake. It's more about being able to provide better services for our members and our clients, be able to provide better support. Also, we're going to have a much, a bigger access to a broader range of investment opportunities so that we can continue to deliver those strong returns that our members have come to count on, as well as trying to drive down the total member cost to operate the fund, which means that we can pass on those savings to our members through lower fees. So there are lots of good things ahead for us. And with that change, we also have made another change. And I'm going to get Jess to play the video just so that you can see. So I'll just stop sharing and come back to you afterwards.
Thank you. I'll just take over the screen. There it is. Everyone can see. Can everyone see my screen? A new name for First State Super?
Yeah, I can.
Yep.
Cool. Right, here we go.
At First State Super, we're aware our members seek to improve life, not just for themselves, but for all. Because we're aware, we help members achieve their goals in line with their values. We believe there's no need to sacrifice integrity for performance. So we invest to improve our communities, to build a more sustainable economy and support growth. By looking ahead, we strive to ensure no one is left behind. Aware Super, a new name for who we've always been.
I'm excited to announce that from mid-September we'll be known as Aware Super. Aware Super is a name that best describes the essence of who we are, who we've always been, and who we strive to be in the future. It's also the name we chose together in consultation with many of our members. We're aware that we can have such a positive impact on our members and their communities by investing responsibly. And as a fund, we want our members to be aware of their super and support them along the way to ensure they're both confident and comfortable with what the future may bring.
Thank you. You can take over, Felicia.
Okay, so there you have it. We are changing our name to Aware Super. As our CEO, Deanne Stewart, said, it's just a new name for who we've always been. So we know that the superannuation sector is consolidating, which means that many super funds are merging to create bigger funds. And over the next few years, we believe that the industry is going to be led by a handful of larger super funds, and it's our intention to be one of them. So like I said earlier, being bigger enables us to pass on the benefit of scale to members and, will allow us to deliver better outcomes for our members, their families, and communities. But in order to support those growth ambitions, we realized we needed a strong brand that is clearly differentiated from other super funds. As we are no longer just New South Wales, we have to account for all of the other areas that we are involved in. We wanted to have a more inclusive name, the name that we picked in consultation with many of our members, and it just reflects who we are, our actions for members, and we believe that it's a key to ensuring that we stand out so that we grow and can continue to deliver more value to our members. All right, so we will get into the meat of our presentation. So we're going to talk a bit about managing money, everyone's favorite topic. For a lot of us, this basically comes down to budgeting, getting the books balanced so we're spending less than we earn. Sometimes easier said than done, right? Now, this is a slide of money behaviors that the Financial Times did an article about, the psychology of money. So they identified 6 money behaviors. And this is what we think about when managing money. It's important for us to consider what our money behavior or attitude is. Now, you might be an anxious investor, so you're someone that is prone to overtrade. You have a tendency to want to do things instead of not do things. So you might often be changing your investments or, selling, buying high, selling low. Things like that, removing risk when things feel bad. You might be a hoarder. You might be somebody that abhors risk. You may even stockpile cash that could be better off investing or even spending. If you were raised in a family where money was tight, you may tend towards this type that needs security. Or you're the social value spender. Does shopping make you happy? I know it makes me happy. Do you frequently buy your loved ones gifts just because? Debt problems can often be the end result of this type of money behavior. Women aren't the only ones to exhibit this behavior, though women may spend more on clothes and bags and shoes. Men may, tend to buy expensive cars or gadgets. Or you could be the cash splasher, which is related to the social value spender. And this is somebody that views themselves as generous, but they also use money to make others think more highly of them. Or you could be a Fitbit financier, somebody who checks their bank balance, tracks their spending as often as someone training for a marathon. This one is all about control. As some people find it really hard to deal with unpredictability, they can become super organized with money, which can often lead to anxiety as you often stress over, comparison tools or credit card points, things like that. And finally, we have the ostrich. So this is someone who would rather bury their head in the sand than to organize their finances. It might just be all too stressful. You don't know where to start. Making no decision feels better than making a wrong decision. In its worst form, it can really cause anxiety, and you may find it all too difficult and just give up before you start. Now, I'm not saying any one is better than any of the others. It's more just for us to reflect on, to see what it is that we view, our attitude towards money, how we view it. It could be on the way that we were brought up. If we had parents that were, people that saved their money, or if you had parents that were, visible spenders, you might do the same thing. You might repeat the same behaviors, or you may have gone and done the opposite to them, or you may have been influenced by relationships or events in your life that led you to form different kinds of attitudes and behaviors. But if you're interested in taking this, you can Google the Financial Times Money Behaviors. It's about 18-question quiz. It's quite it's quite informational. It's a really good read just to have an idea. Because whatever your behavior, it's really important to reflect so that we can better understand why we manage our finances in a certain way, and that way we can look at ways to improve or adjust our habits. Now, I'm pretty sure everyone has some form of budget, whether that's a budget in your head or a formal budget that you keep on spreadsheets or online somewhere. But the whole idea of budgeting that we know is tracking our money coming in and going out, knowing what we're spending on, and also a way to create goals. So while we all have our own individual methods of budgeting, this is just one idea of what can happen when we break things down to better understand what we spend on. Now, you might be familiar with spending buckets. So these are a way to manage our money that involves breaking up our monthly spending into these three categories. Now, this is just one method we're highlighting. This isn't the end-all be-all budgets. You probably have heard about the Barefoot Investor. He talks about spending buckets as well. His are a little bit different in how he breaks them up, but essentially they're the same concept. We are separating things such as needs from wants, and we might be using our bank statements or our online banking system to help us review what comes in and goes out. So the first bucket is needs. So these are the non-negotiables in life. This is the rent and mortgage, the food, utilities bills. Now, I say that these are non-negotiables in that we all need a roof over our head, we need food to eat, but it doesn't mean that this needs category can't find ways around reducing what we spend in that. We might think of these as, these are non-negotiables, but we might think of things as these are fixed costs, but they don't have to be. There are different ways that we can shave off the excess in this bucket. Things such as renegotiating our mortgage rates. Because mortgage rates are at an all-time low right now, it's really worth people checking to see if they're getting the absolute best rate they can. And food-wise, maybe shopping at a cheaper supermarket or shopping the sales, and using recipes according to the kinds of foods that are on sale for the week ahead. There's lots of different ways that we can try and reduce our costs in this way. I know when the pandemic hit, my partner had lost a little bit of work in his teaching, and so we had to reduce our Harris Farm trips. and started shopping at the more discount places. But it was fine. We were still eating well, but it just made a difference in our food budget. So that wasn't a fixed cost. It was something that we could reduce. And you might even look at getting a better deal on your gas and electricity. A lot of times we think, oh, well, there's really nothing I can do, but there are websites that can help us compare different companies to see who's offering the better rates. I've done this myself, where I called up the company that I've had and asked them what they could do, that I was shopping around and wanted to find the best rate. And you'd be surprised that they really want to keep you as a customer, so they may be willing to offer you some really good deals. If anyone's ever tried to get rid of Foxtel, I can tell you that they will try to keep you as a customer by offering you all the best deals, which is, what I wanted, before I signed up with them. But definitely there are ways to get better deals on all of those. But essentially in this bucket, these are costs that are largely unavoidable, but we have to make sure that there's money in this bucket first. The second bucket is our goals. These are our savings, what we want to be using our money to maybe reduce debt or pay for holidays. Right now, if we're just saving for holidays within Australia at the moment, we're paying down a car, education, or even adding a bit extra into super. So money should be set aside to this bucket after bucket 1 has been covered for the month. Now, once this bucket is completed, then anything left over gets put into bucket 3. And essentially they're saying if you don't have anything after paying buckets 1 and 2, that bucket 3 gets nothing. So assuming that there is money after you've set aside for buckets 1 and 2, this extra one is the discretionary spending bucket. So this gets set up as a separate account. So these are the little luxuries that make us happy, like, eating out, going to the movies, or, in this day and age, it might be, getting in Uber Eats or watching an online movie for $20 instead of spending the $50 we would have otherwise outside of our house. But this is obviously discretionary spending. So we can't take the money from buckets 1 and 2 to be able to use, money for this bucket. Now, like I said before, with the Barefoot Investor, he has some different methods where he puts a little bit of mad money in the first bucket. Now, that's why I'm saying there's no one method that's going to be working for every single person, and that's why you have to find the budgeting tool that works best for you and what's going to keep you on top of it. I know if I didn't have a little bit of extra money budgeted, to have some fun, it would probably drive me insane. So I make sure that I use a method that allows me a little bit of mad money, but at the same time, I'm still paying down, things in my goal bucket to make sure that those things are taken care of. So like I said, no one size fits all approach to budgeting. Every situation is different. There are lots of online budgeting tools that you can use. We have a budgeting calculator on our website that you are welcome to use. You don't have to log in to use it. But anything, even going to moneysmart.gov.au, can be really beneficial in helping you maintain a budget. And if you're somebody who's good at personalized spreadsheets, it might be worthwhile to have a look at your budget again to see if things have changed, or see how you can maneuver things, maybe to refine your goals, or look at even shaving down your budget within the needs bucket. The main variable that drives the successful budgeting system is just being proactive and honest about what your objectives of budgeting are for you. It takes practice and time to change habits, but it means that we have to take the first step in getting there. Now, what if you find yourself, as many of us do, with debt that has to be paid off? Almost everyone who buys a house does so having to borrow money through a mortgage, so debt is very common. In fact, debt is essential to most economies by increasing the amount of money in circulation and allowing investments to be made. But there are different types of debt, and not all of them are the same. So good debt allows us to manage our finances more effectively, to leverage our wealth, to buy things we need, and to handle unforeseen emergencies. Examples of good debt are taking out a mortgage, buying things that save you time and money, buying essential items, investing in yourself by borrowing for more education or to consolidate debt. Each may put you in a hole initially, but you'll be better off in the long run for having borrowed that money. Anything that decreases in value the minute after you buy it is usually considered a bad debt. Unfortunately, that describes many of life's basic necessities like clothes and cars and that 60-inch flat screen TV you need to watch all those NFL and AFL games. So apart from HECS help debt, there are 3 other types of debt, and they can all play a role in helping us to finance our lives. It's still important to manage our finances and to keep to a budget so that debts don't build up and become insurmountable to pay back or to manage. So we're just going to briefly look at these in turn. So credit card debt, it's a short-term debt. We know that the plastic can ruin our financial health, and interest rates are the silent killer. Figuring them out is downright confusing at times, and that is just fine with credit card companies. If consumers knew how much they're actually paying for using their card, they'd probably storm the mansions of every credit card company president. Remember that 60-inch flat screen TV I mentioned? Say you got lucky and you found one at a sale for $1,200. If you put that on a Visa card with an 18.9% interest rate, which is very common, if you paid $60 a month, which would be more than the minimum required, it would take 63 months to pay off and cost a total of $1,676.98, which is a hefty premium to watch footy in high def. So paying just the minimum repayment each month can mean that a card can take years to pay off and cost much more in interest charges, which is why banks love them. If you have a credit card that's proving difficult to pay off, it might be worth considering a transfer balance to a zero interest card, keeping in mind that that zero interest period usually only applies to the balance transferred and that any new spending would attract new interest. Or maybe consolidating multiple cards into one and having a single payment can also be very useful in eliminating credit card debt. But if you have a credit card that's proving hard to pay off, it's often a sign that we are spending more than we are than possibly should be, and that's when we have to revisit our spending priorities and we have to cut back on discretionary spending, and that's worth considering. The second one is investment debt. So this is typically known as a good debt. Investment debt, of course, we know is borrowing money to use for the purchase of an asset that will hopefully provide us with some income and some capital growth. So maybe buying an investment property or borrowing to invest in shares, all of which will hopefully bring us in some sort of income and growth. And there could be tax benefits associated with investment debt, as the interest payments could be deductible from your income tax bill. But obviously there are risks with this kind of debt, as with any debt, because if it doesn't perform well, then interest payments still have to be made to the bank each month and principal repaid. But definitely a way that people use to build wealth. And the last one is mortgage debt. There's probably, no other debt we know better than a mortgage. For one thing, we have to live somewhere. And for another, you might as well live somewhere that gains value every year. Most people who buy a house will have a mortgage because a lot of us can't come up with that cash to simply buy a property outright. We know that a mortgage will usually take anywhere from 25 to 30 years to pay off, and making any extra repayments along the way means that we're reducing the time and the amount of the interest that we pay. Of course, it's secured against the asset, which is the house we buy, and we hope that over time that house will increase in value while the mortgage falls. Now, the stress that can come from the prospect of having your house foreclosed if you can't make the payments can be very real, especially in times of financial troubles that we've seen during the pandemic. So with any financial products, with any kind of debt, it's worth shopping around for the best possible rates. If you already have one, then don't be afraid to try negotiating a better rate with your bank. It is a very competitive market, and you'd be surprised about the kind of offers that they could give you to try and get that reduced. So a simple rule is if it increases your net worth or it has future value, it can be considered good debt. If it doesn't do that and you don't have to have cash to pay for it, it could be considered a bad debt. Then this is where a licensed financial advisor can help. If you do need more information on debt and how you use it effectively, it could be wise to speak with a financial planner. Now, this is one activity that I actually found very helpful when I was going through my divorce at the time, and I suddenly had to become the sole financial guru. I had myself to worry about, and I had no clue where to start. And while this activity was really confronting to me, I also found it really beneficial because I had a budget in my head. I had an idea of what I owed, and it was all up there. I wasn't late on payments or anything, but by doing this activity debt evaluation, I put everything down that I had owed, who the creditor was, the amount owed, all the minimum monthly payments, what the interest rate was, when the payoff due date would be, as well as the due dates of those things. And by doing that, I actually realized that I had underestimated the amount that I owed. And I was quite surprised by that because it threw off my figures by quite a lot. So it was actually really good to do, as confronting as it was. And it helped me get on top of my debt. So I sat down, gave it an evaluation, summed up the debts I had, and I was able to have a bigger picture, like a holistic picture of the debt to make it easier to see what it was actually costing me. And this can be really helpful because you can help this manage your debts to assure that you stay on top of repayments, but not just staying on top of repayments, but coming up with a plan to help eliminate them. And this might be something like, looking at your the most amount that you owe and starting to chip away at that, or looking at your highest interest rate and starting on that first. Or you might even start at the smallest debt, and once that's paid off, you have a sense of relief and completion, and then you take the money that was applied to that debt and apply it towards the next highest debt, creating a sort of snowball effect. And you can start to see that something's taking place, and psychologically it does help us in feeling like we've accomplished something. So while this can be a little time consuming, it's actually so helpful, and I would recommend it to anybody to do to get started. Now, along managing money and debt, we also have to consider our credit rating. Now, for many of us, credit rating is simply, something we just haven't looked at. In fact, when we do a lot of these seminars, we ask questions about who has checked their credit rating, and a good portion of the people we speak with have never seen theirs before. We find this quite common. But if we ever plan on buying a house or getting a car or borrowing money for any reason, we have to make sure that our credit rating is looking good. So the first step is getting a copy of your credit report. This can be done on moneysmart.gov.au. They have some excellent resources. You are entitled to look at your credit report free once a year, and it's a really good idea to do that for several reasons. The first being, you have to make sure that your credit rating, your credit report is up to date and has all the relevant information, and make sure that there's nothing on there that shouldn't be. So your credit report is going to contain all the information related to credit products you have, your repayment history, defaults on bills, loans, or credit cards, credit applications, bankruptcy, and any debt agreements. So if you come across one or more of those entries in your credit report that you believe are negatively impacting your rating, whether that's a disputed phone bill or a card limit being exceeded, you can contact those credit providers directly and resolve those issues. Because I want you to be aware that a payment default could remain on your file for up to 5 years. So check and make sure that all the loans and debts listed are yours. Check your name and date of birth details are correct. And if something's wrong, contact the credit reporting agency and ask them to fix it. This is a free service. And it also lets you check and see if there's been any attempts at identity theft in which people have tried successfully or not successfully to gain credit in your name. I think they said something like 700,000 Australians were the victims of identity fraud in 2013-14, so it's definitely not something to be ignored. The second one is to pay all of your bills on time. So we know we're more likely to lend money to a friend who always pays us back quickly than one who doesn't, and your credit rating works the same way. A lender is going to look at a record of consistent on-time payments, which will do wonders for our overall credit worthiness. It may seem simple and obvious, but these are definite things that can keep us in the green. The third one is to pay off debt regularly. So paying the minimum amount due or more if we can afford it on any credit cards or loans each month shows that we're capable of managing our money effectively. The average credit card balance in Australia is about $3,231 with an 18% interest rate. So if you pay just the minimum, it would take about 26 years, and you'd pay about a little over $10,406 in total. So making higher repayments could cut that down to a couple of years, and we pay much less over time. But showing that we're paying it off regularly can definitely improve our rating. The fourth one is not to apply for any new lines of credit unless we really, really need them. Every time you apply for a new credit card or a credit account, your credit rating actually takes a ding. So if we really, really need them, then we can do that. But we do know that if we're using more than 30% of our available credit, that our credit score is going to suffer. That means higher interest rates when we apply for a loan or a new credit card. And the last one is to keep up to date with a credit file. So checking our credit file at least once a year means that we're ensuring that that report remains free of errors, we haven't been the victim of identity theft, and that we know exactly what is on our credit rating at any given time. It all just falls down to a really important formula: keep your credit rating in the green now and reap the benefits later. Other companies that you can check out are Equifax, Experian, and Elion. So there is help here if you need it. If you do find yourself struggling with debt, don't be afraid to ask for help. 1 out of every 2 Australians deals with some sort of financial stress. We've all been there at times in our life. The Money Smart website that Scott has put in the chat link is a really good place to start. It has some really interesting information and ways that we can get debt under control. And you can also contact a financial counselor if you find that you need more help. But really important that we add up all our debt, that we look at what's coming in, going out, considering our priorities and our spending habits, how we look at money, looking at where we can save and what our new goals might be, and consider refinancing if we need to get our mortgage rates under control or our credit cards. Because don't even be afraid to try and refinance a credit card rate if you have to. The worst they can say is no. But please do get help if you're struggling to manage. It's not something to be embarrassed about. There is help out there. You can also try finder.com.au to help you do some comparisons. That's a good place to start as well if you're looking at trying to track your spending. So we're just going to talk a bit about getting engaged with your super. Now, the reason we're mentioning super is that it is an important part of our finances because it's probably one of the largest amounts of money that we're going to have outside of our bank accounts, savings accounts, and our homes. And most of us do have super account. So at its basic level, super is just an effective, tax-effective way to save for retirement. So anyone who works for an employer will have 1 or more superannuation funds. Hopefully you only have the one, so you're not paying any excess fees. So basically, A sum of money is added by your employer and you if you choose to, and this money is invested over a long period of time, anywhere from 20 to 30 years, and sometimes longer for people that are just getting into the workforce now. So when you get close to retirement, this is when you can access your super. There are some restrictions on how you can invest your super. It generally comes with some tax concessions, and there are some rules put in place to control our access to the money if we're not fully retired, because it is generally used in retirement. So I just want to talk to you about some relevant information about superannuation, but this is what I want you to take from this, that super is real money and it is your money. So it really pays for us to pay attention to it sooner rather than later. Having some knowledge about it can be really useful. And don't forget, you can get help with advice regarding your super, which I'll talk more about later in the presentation. So currently, your employer has to put in 9.5% of your ordinary time earnings into your super. So this is on top of your regular salary. This is money that gets put into the account of your choice. They have to pay this at least quarterly. So on an average income of about $82,420, you're looking at a contribution of $7,830 per annum. Now this is no small amount. This money is put into your account and invested, and anything that it earns in investment earnings is then reinvested, creating a compound interest environment. So the contribution that your employer puts in is taxed at 15%. They do have plans to increase that 9.5% to 12% by July 1st, 2025. Of course, that was already knocked back in the schedule a little bit. And there's talks about, you may have heard some recent information about, trying to increase that level to 12% right away, because figures have, are constantly out about how 12%, while beneficial, is still not enough for people to retire comfortably on. And so this is where that discourse has come in about how much should be put into super. So this is just the basics of superannuation. Now, when I say, putting more into super, we also need to think about what we can do with our super as well. So while we get engaged with our bank accounts and outside accounts, a lot of times we're not checking what our super balance is, or maybe we're not checking it until much later. We get our annual statements, we may take a cursory glance, but we're not really paying attention to it or even what it means to us. So one of the first things that we try to get people to do is to download the app or to register for an online account. See how much you have in your super account today, and then get engaged with it. Check your annual statements. Check what you're invested in. Run a projection. And what I mean by run a projection is if you use this tool we have called Super Projections Calculator, you're able to get an idea of what you could retire on per year and then how long that would last. So it gives us a good idea of where to start, because we don't live in lump sums, so it's easier for us to break it down by year of what we could live on. And then if we find out we're in a shortfall, we can go back in the calculator and change some information to see what that does to our balance in trying to get us to our goals. And of course, checking for any lost super. Because we haven't, Australia hasn't been great about teaching everyone about superannuation. A lot of times we are vaulted into our employer's super fund, which, most of the time can be really good, but it's really important that we pay attention to that. But oftentimes we may have gone from job to job and picked up a few superannuation companies along the way. So we might have excess accounts that are open. Now, if you're not actively contributing to those accounts, that means they could eventually get eaten up by fees or insurance premiums. So it's in our best interest to make sure that we find any lost super. If we're able to consolidate, that we consolidate that. And get it all in one place, because it's easier for us to keep track of, and we're not having our money just wasted away. So you can definitely do that, and we would recommend it. it's in our best interest to make sure that all of our money is accessible and we know exactly. Now, if you find, according to that super projections calculator, that you do need to add a bit more of money into super, there are two types of contributions that we can use to get more money into super. So we're just going to have to take a look at that now. So there's two main ways: concessional contributions and non-concessional contributions. Now, those are just fancy names for before and after tax. So let's look at the concessional before tax. This just means that your money enters the super fund before you pay income tax on it. So pre-tax dollars goes into your account. It's termed as salary sacrifice, the contributions that we make through our employer. So before income tax is taken out by your employer on your wages or salary, those contributions are put into your super fund and taxed at 15%. For most people, the contribution tax deducted as tax would have been, and so it creates a bit of a tax savings, which is why this is so popular with people being able to save for retirement. So they're reducing their assessable income, means they're saving tax and putting more money into super. Now, the second one, the non-concessional contributions, are personal contributions into super. These have all been ready taxed at your marginal tax rate. So if you had money sitting in an account somewhere outside, you had a term deposit, or you came into an inheritance, or you sold an asset and you wanted to put money in personally, you could do it through a non-concessional contribution. This is something that we see people maybe do one-off contributions on, but there are people that do use it as regularly as they do the before tax. So you're able to use both of these. You can do them at the same time, or either or, it's up to you. And also, it also counts on the type of income you have coming in, the level of income, to determine which kind is better for you to take, to do. So tax plays a big part in making superannuation advantageous for us. So we'll just take a look at the effective way that we get money into super and why it's so important. So we'll look at this case study. This is Susan, age 35. She earns $75,000 and she's not salary sacrificing. She currently has $45,000 in her accumulation account and she plans to retire at 67. Now, if she only gets her employer's super guarantee at 9.5%, and of course it's counting in the increases along the way that were legislated, it means that she's retiring at $420,961. Now, if she decides to put $10 extra a week as a concessional contribution, so that's that before tax, she's boosted her balance to $441,412. And you can see that her balance rises as she puts in a little bit more, so that at $30 extra a week, she's now attained a balance of $482,316. Now, she has opted to use this before tax contribution because it's a tax effective option for her. She's only taxed at that 15%, which is much lower than her usual tax rate of 34.5%, which includes that Medicare levy. So for every dollar that she puts into super, it's worth more than the dollar in her take-home pay. And she hasn't put in $62,000 extra dollars of her own in. She has relied on the power of compound interest to help her save more money. The longer we save, the more interest we earn. So the sooner we start, the sooner we can start saving regularly. You'll earn a lot more if you start to do it early than if we try to play catch up later. But it does make a difference, even small amounts, which is why I recommend doing that super projections calculator to see how adding in a little bit extra can change your overall balance. So it's worth thinking about making sure that you have the kind of retirement that you want, and thinking about the things that you're going to want to do. Another way of maximizing our savings is through things like micro savings apps. You may have heard about this one. It used to be called Acorns, but now it's called Raise. Now, we know that spending is a part of life, but that doesn't mean that we can't save too. And the Raise app makes it easy to do both of those things. So what it does is you download the app and you link it to your credit card and you pick a super fund, hopefully that's us, and you choose how much you want to round up your purchases to, maybe to the nearest dollar or whatever amount you choose, and investing the rest. So it gets invested in these micro investments. You watch the Raise savings grow whenever you spend money. And then when you get to a certain amount, you can shift your savings into your super to reward your future self. So you're essentially paying your future you to have a better retirement. Or, you can simply use that money for what you need to. But it means that even small amounts can be saved. So we might not, notice, rounding up our coffee purchase by an extra 50 cents, but we'll definitely know when we're in our 60s and in retirement that we'll be glad our younger selves did something earlier to save for that. So it could be a beneficial way to get a little bit more money into super. So this is how you can receive assistance from us on the things that we have covered today. Now, I mentioned about Lost Super, really important that we get that together. If you're a member with us, you can go to our website and we have a search and combine tool. People that are not members of with us could use my.gov.au to find any Lost Super. And if you think somebody who might want to be a member with us, it's very easy to join. They can go to firstdatesuper.com.au/join, or they can download the app and join that way, or simply use the old school paper form. But there's lots of great reasons to join First Date Super, and if you think that somebody could benefit from being a member with us, we'd love to have them come and be a member. But like I said, consolidation of multiple accounts may be worth considering. There's still something like 18 billion lost super in some ATO held accounts. So you could be one of them. It never hurts to check. You might have forgotten about some employment you did when you were 18 or 19, and you might want to get that all together. If you need to contact us, you can go to our website, firstdatesuper.com.au, or you can contact us through our phone support line at 1-300-650-873. Now, Scott has put up a link to a feedback form. So what this is if you click on that, it will allow you to get some assistance, whether that's around simple advice, if you're a member with us. So simple advice can relate to anything about contributions or some insurance or how you should be invested. Or if you need something more complex, of course, we can put you in touch with a financial planner. I would recommend going to the website because there's lots of valuable information. And I would also recommend that moneysmart.gov.au website, which is a good way to get help with managing money and debt. But whatever methods you choose to handle your money, just remember that there is lots of help out there. You don't have to do it alone. And that's one of the things that we try to do, in giving you this financial literacy information, is because the more information you have, the better off that you are eventually, because all information is good information. And you don't know what you don't know until you learn it. I was definitely someone that benefited from this. Probably in my early 30s, I had somebody come in and help me and teach me, and that's because of that help that I was able to turn around my financial situation and be in the position I am today. And then that's why I'm so passionate about paying it forward and giving this information to anybody that needs it, because we can all benefit from learning a little bit more. I'm going to go to Scott to see if there's been any questions so far.
Yeah, Felicia, fantastic. Such amazing information going through. Every time I hear this, it reminds me that I have to talk to Foxtel and see if I can get a discount. But not only Foxtel, all of the utilities, and I do need to actually sit down and see if I can give them a call and save a few dollars, because it's certainly worthwhile. I have put up a few links on the chat function there for people. So if they
Yes.
wanted more information on anything that you've spoken about, there's lots of fact sheets, all on the
Fantastic.
contributions that you spoke about. So whether that be looking at helping them from a budget perspective right through, and then also the advice form on there. So lots of information, really clear, really concise. We have an amazing group with us today who were just absorbing the information and haven't asked any questions as yet. So we are here and happy to help if there are any questions.
I do see one has come through. I presume there are various types of investment options that are available from First State Super. I wonder how often I can make a change or if there's any charges to make a change. Yes, so we have 12 available investment options, 5 premixed and 7 single asset classes, so 12 overall. You are welcome to make any kind of investment change that you would like to. There is no additional fee for changing your investments. But this is where I think that some simple advice would be really beneficial. We actually have a webinar that talks about investments, namely investing in uncertain times, because we did see lots of changes with the pandemic, and it, made markets go kind of haywire. So it's really good information. If you're interested, you can go to our website and register for that. But basically, we talk more in depth about investments, about investment volatility. We talk about how the fund is unitized and why it's really important to stay the course and think long term instead of just short term, according to the headlines. It could be really beneficial. You can also get some simple advice from one of our superannuation advisors that can take you through a risk profile to make sure that you're in the exact right investment portfolio for your individual circumstances. While we might be prone to making knee-jerk reactions to the market, it's really important that we're in the correct investment option for us. So going through a risk profile could be very beneficial and can really help. I did that a few years back. And I've already seen a big difference. So I would recommend either getting some simple advice around that or looking at our webinar first.
Yeah, and we've got a follow-up question from that. Is there a daily performance index or chart published to members to look at? Absolutely. So I've actually just popped a link on there, which actually refers people to the current investment performance, where it gives you, over the last week, last month, 3 month, 6 month, going right up to a 10-year performance on all of the different investment mixes that we have. Of course, past performance is not indicative of future performance. However, it does certainly allow you to have a look at the different investment options that are there and perhaps give you a bit of a guide for going forward.
Perfect.
Great question. Love it.
Yes, exactly. Thank you so much for putting that link up there, Scott. That's perfect. Yes, there's also a list of companies that we invest in. We also invest in some socially responsible investments. So if you are socially minded, you can have a look at what we do there. We've got lots of information. We also have a webinar related to our socially responsible investments that you can check out. Is there
daily data? I'm not sure whether it goes down to the day. It may do actually on the website. It could be from.
I know they update monthly. I'm not sure about the daily rate because we have to take into account other global markets, which is all different hours.
Yeah,
that are different from ours.
I absolutely know that there is a. Definitely, it's weekly. I'm not sure if it goes down to daily. But if you click on the link, it'll actually take you to the investment performance and will actually highlight all of
so
the
weekly,
things.
Don't know about daily. Okay.
Yeah, there's
Brilliant.
definitely a weekly one. I'm not sure if it goes down to daily. It's a great question.
Okay. Yeah, it is.
I love these things because I get to learn too. I need to go and find that out now.
We'll have to go back to our investment managers and find out. Was there anything else? Anyone else have any questions around that? We hope that this has been useful. We want to, thank you so much for coming in today and, giving up your time to learn about this. So we thank the Silver Chain Group and the administrators and the staff that have worked with our relationship manager to make this possible. It just goes to show you how your employers go above and beyond to try and help their employees. So we are very grateful for being allowed this opportunity to give you this information. And I'm sure in the future there will be more subjects to talk about as well as we go through this pandemic together, but hopefully this has been informative and helpful. And if it hasn't been, something that directly relates to you, there's always people in your life that you can share this with, whether it's a friend or your children or, your family members. Everyone can make use of this information. We need to normalize talking about finances. It might be a little awkward at first, but, sometimes just starting that conversation, even something as simple as, have you checked your super balance? You might get a weird look, but it's only weird once.
Fantastic. Thanks, Felicia. We might hand back to Jess. We're coming right
we'll
up
go
to
ahead
the
and
hour,
hand back to Jess.
just to see if there's anything else.
No, that was great. I really enjoyed that, and I think everyone else did from what it seems like. So I'll stop the recording now.
All right. Thank you so much.